going back to my prior thing of are interest rates stimulatory or depressing? If they let the private sector have the full negative consequences of those rates, then they would balance out or maybe even favor the disinflation still. If when they raise rates, if some banks go bankrupt, and importantly, if deposits that are above the FDIC insurance limit, if they get a haircut because they invested in a bank as unsecured creditors, and that bank went bankrupt because ironically they held risk-free assets with long duration, that would actually that would actually destroy some of the money supply. If you got $1 million in SVB and you lose some of it, and FDIC insurance only covers some of it, and you lose a couple $100,000, you damage your spending power. You're gonna spend less, and therefore you're destroying money, you're destroying some consuming power, and it's ugly. But they didn't want to do that. They said, look, we want to raise interest rates, which ironically blows out the federal deficit. But at the same time, whenever these private sector things blow up too much, we're gonna bail those out. And so basically, they could have had deflation, but they didn't want the consequences, which would be people don't trust the banks anymore. At the end of the day, they're not really going to let the banking system become something that people don't trust anymore. And businesses have to kind of have all these extra frictions of kind of spreading their money out so they're never above the FDIC limit. And they didn't want that. They didn't want kind of this like everybody checking all their banks like financial statements, especially because a lot of banks aren't even public. How do you check a small bank's financial statements, and how do you prove that they're solvent? And so at the end of the day, they blinked and they said, look, we're going to keep increasing the interest rates, which blows out the federal deficit. But whenever there actually is private sector contraction, we're going to bail it out. It doesn't mean they're going to bail out everyone. For example, commercial real estate, there's really no cavalry coming there. But if it's a small enough market, they don't care. $1 trillion or $2 trillion in losses of commercial real estate equity, they don't really care about, because it doesn't result in that kind of systemic instability. But banks, they care about. Function of the treasury market, they care about. These are things that they blink whenever they have a problem with. And so you get that effect where the monetary policy becomes less flexible because of what's happening on the fiscal side.
In a recent discussion, financial analyst Lyn Alden sheds light on the looming banking crisis in the US economy, predicting potential consequences of current monetary policies. With interest rates fluctuating, there's concern about the fragility of banks, particularly regarding deposit insurance limits and the risk of insolvency. Alden warns that while policymakers aim to maintain stability, there's a delicate balance between fiscal and monetary measures.
Well, I mean, they can provide liquidity to treasury markets, basically that their options narrow. And so you could get a case where the Fed has to go back to balance sheet expansion despite the fact that inflation's above their target. Or we've already seen the Treasury, for example, shortened their average duration of Treasury issuance, which is, it's a directionally similar to what you see in emerging markets when they have a fiscal crisis. It's not the extreme case where they might have their entire debt is like overnight paper, for example. That's extreme case, but it's directionally similar. That when you find, back a year ago when the long end of the curve was kind of getting liquid and the yields are going up pretty quickly, and then the Treasury started shortening their duration and issuing more T-bills and pulling capital out of reverse repos and back into the market. That's directionally an emerging market phenomenon. That's a fiscal dominance, long-term fiscal crisis type of issue. So yeah, the Fed and the Treasury have any number of things they can do to ensure liquidity in the treasury markets, but the problem is they can't necessarily do that while also trying to keep financial conditions tight to fight inflation. Basically, it's like one of those two variables has to be a problem, and they're always going to, 99 times out of 100, they're going to let the inflation fight weaken if it means saving the treasury market or saving the consumer deposits in banks or business deposits in banks. Those are two things that 99 times out of 100 they're going to save. You never say never, but if you had to bet, that's really that's where their incentives lie. Let's put it like that. And so yeah, that's kind of the situation they find themselves in. But there's still cycles there. There's still periods of time where they push back. They temporarily get inflation under control. They kind of put us into a light recession or a near recession, and that can put downward pressure on this. One of the problems is that whenever they slow down the economy to try to fight inflation, because the tax base is so financialized. If asset prices have a weak year, then the next year has pretty weak tax receipts.
Mhm.
And so let's say they try to cut let's say in the unlikely event that Democrats and Republicans get together and say, we're going to cut the deficit by $500 billion going forward per year. It's a pretty big cut. It seems extremely unlikely they would do that. But let's say they managed to do it. Probably what would happen is GDP would slow down, and then you'd have weaker asset prices, and then next year you'd have weaker tax receipts, and so a good chunk of those cut deficits would actually come back because tax receipts would be weaker, which would be not the case if you had a less financialized economy, but because so much of our tax base is tied to asset prices, that's a fact that they have kind of built in. And so there's really not a lot of easy ways out of the situation, other than just this ongoing debasement relative to scarcer things is kind of how they're going to do it. That if at some point unemployment's getting bad, that becomes more politically painful, so they emphasize that more. If at some point inflation's getting bad, they try to emphasize that a little bit more, but they can't kind of return to equilibrium, at least for kind of any sort of reasonable investment horizon. Let's put it like that.
Continuing the discussion, Lyn Alden dives deeper into the implications of potential interest rate cuts and their impact on global markets. Alden suggests that while rate cuts may seem stimulatory, their effects are nuanced, influenced by various factors such as employment mandates and economic instability. She emphasizes the complex interplay between fiscal dominance and inflationary pressures, highlighting how both high and low rates can fuel inflation through different channels. Alden suggests that while current policies lean hawkish, future rate cuts could trigger a commodity price surge, particularly benefiting regions like Latin America and South Asia.
Well, they often cut rates because there's economic weakness, because their employment mandate is now beginning to take priority, or because there's some sort of instability that they're dealing with, right? For example, the banks having problems or the treasury market's having problems, something like that. And so, if they were to cut rates, on some level, I don't think it'd be as stimulatory as people think, because part of it would actually reduce the deficits a little bit. On the other hand, it would probably increase oil prices or otherwise weaken the dollar relative to other currencies, and it would probably give those other, so let's say emerging markets, they have a lot of dollars on mid debt. So when the dollar hardens relative to their other currency cash flows, it squeezes them, it slows them down, it reduces their growth rate for energy consumption, things like that. It has a somewhat disinflationary effect there. If they cut interest rates, it gives them more breathing room, and therefore they probably grow a little quicker. They probably consume a little bit more energy, which around the margins is inflationary. And the hallmark of fiscal dominance is that whether you keep rates high or you try to reduce rates, they both have inflationary aspects to them, just through different mechanisms. If you keep rates high, you're inflating through huge deficits in your interest expense. If you cut rates, then you're having fewer foreigners want to hold your currency, and you're probably increasing the expense of energy and things like that, at least all else being equal. So I think overall, rates are less important going forward than some of the other variables that are at play here. So they should be good for commodities, but again, it depends on why they're easing, right? If some of these deflationary forces do temporarily override the fiscal force, then the moment they cut rates, you might not get a jump in commodity prices because the falling in demand is a bigger factor. But I think over the longer term, should they find themselves having to ease for a variety of reasons, I do think you'd get increases over a multi-year period in gold, in energy, potentially in copper and other commodities like that. And so right now they're running pretty hawkish policy, which keeps the dollar strong, which keeps, kind of indebted emerging markets more slowly growing. But if they do have to cut, you probably get a little bit of a boom in Latin America. You probably get a little bit of a boom in South Asia. That probably is good for commodity prices. It's probably good for commodity prices in dollar terms. Whether that happens in the 6 months, after the cut, it depends on the reasons. But I think that's a more structural story.
Today's discussion with Lyn Alden has provided valuable insights into the intricate dynamics of monetary policy and its implications for the economy. We've learned about the delicate balance between interest rates and fiscal measures, the potential consequences of banking crises, and the nuanced effects of rate cuts on global markets. As we navigate these complex topics, it's crucial to stay informed and engaged. If you found this content valuable, don't forget to subscribe to our channel for more expert analyses.